Never trust a financial system that needs constant life support to survive because right now, the machine keeping your retirement alive is running on borrowed time, and most people have no idea the game already changed. Hi, my name is Bob, and I've been studying monetary systems for the past 15 years. I manage a seven-figure portfolio spread across multiple asset classes, and I'm not here to sell you anything. I'm here because after reading hundreds of pages of central bank reports and IMF documents, I realized we're not heading toward a normal recession. We're watching the slow motion collapse of the financial rules that built your 401k. And in the next 15 minutes, I'm going to show you exactly why this matters for anyone planning to retire in the next 20 years. Let me paint you a picture. In March 2020, the Federal Reserve created $4 trillion in 8 weeks. In 2021, governments sent stimulus checks to people who never lost income. In 2022, Russia got removed from the SWIFT payment system after invading Ukraine. In 2023, China and Brazil started trading oil without using dollars. In 2024, central banks purchased more gold than any year since 1950. And right now, in early 2026, the 10-year Treasury yield sits higher than it did during peak inflation. Here's my question. When does a recession stop being the thing we worry about? Think of the global financial system like a lease agreement. After World War II, the world signed a lease with America. The terms were simple. The U.S. dollar becomes the global reserve currency. Everyone trades oil, goods, and debt in dollars. In exchange, America maintains a stable currency, keeps inflation low, and protects global trade routes with military power. That lease has been running for 80 years. But long leases create problems. The landlord starts taking liberties. The tenants start looking elsewhere. The first liberty came in 1971 when President Nixon closed the gold window. The dollar stopped being backed by anything except trust. And for decades, trust worked. America had the biggest economy, the strongest military, and everyone needed dollars to purchase oil. But trust is a psychological asset, and psychological assets decay when abused. The U.S. national debt now stands at $36 trillion. That's 120% of GDP if you earned $60,000 per year, but owed $72,000 on credit cards. Your debt-to-income ratio would match the United States government. After World War II, debt to GDP hit 106%. But here's the difference. Back then, America had a young population, a massive manufacturing base, and was a net creditor to the world. Today, America has an aging population, outsourced manufacturing, and borrows money to pay interest on money already borrowed. When you're running this kind of system, you have two options. Admit the problem and restructure, or keep finding new buyers to continue the cycle. For 15 years, the Federal Reserve has been the buyer of last resort. Every time Treasury yields spiked, the Fed printed money to buy bonds. That's called monetizing debt. It's also called inflation. But this trick only works if the world still needs dollars. Ray Dalio, who manages over $100 billion at Bridgewater Associates, talks about the big cycle of internal disorder. When wealth inequality hits extremes, societies fracture. In 2024, the top 1% of Americans held 32% of all wealth. The bottom 50% held 2%. That gap exceeds 1929 levels right before the Great Depression. Inequality alone doesn't break systems, but it creates political instability. And political instability makes people nervous about holding long-term government debt. So what do? You buy gold. You buy real assets. You move into currencies not tied to politically unstable systems. Central banks purchased 1,037 tons of gold in 2024. China, Russia, India, Turkey, they're not buying gold because it's shiny. They're quietly exiting the dollar system. Now, you might think countries have predicted the dollar's death for decades and been wrong every time. But here's what changed. Russia invaded Ukraine and got kicked from SWIFT. Instead of collapsing, Russia started settling trade with China using yuan and rubles. China and Brazil made deals to trade in their own currencies. India buys Russian oil with rupees. Gulf states that priced oil in dollars since the 1970s now openly discuss pricing in multiple currencies. When you weaponize the dollar, you teach the world to build systems that don't need the dollar. Once alternatives exist, everyone nervous about being next starts using them too. It's the psychology of a bank run. The bank doesn't fail because it's insolvent. It fails because people think it might be, so they withdraw money, which makes it insolvent. Let me show you what this means for real people. Meet David. He's 42 with $350,000 in his 401k. He earns $110,000 per year, contributes 6% of salary, and his employer matches 3%. Every retirement calculator says he's on track to retire at 65 with $1.8 million. That math assumes three things: 7% average annual returns, 2.5% inflation, and the dollar he retires with in 2049 buys roughly the same goods as today's dollar. If we're entering monetary transition, all three assumptions break. If the U.S. government, facing a debt crisis, lets inflation run hot to erode debt's real value, everything changes. Every country in history has done this when unable to pay bills. If inflation averages 5% instead of 2.5 over 23 years, David's 1.8 million only buys what 800,000 buys today. He lost $1 million of purchasing power and doesn't know it yet. If the dollar loses reserve currency status, even partially, U.S. interest rates must rise to attract debt buyers. Higher rates mean lower stock valuations. The S&P 500 is priced for an environment where America borrows cheaply forever. If that breaks, we're discussing a complete repricing of every dollar-denominated financial asset. David's target date fund, which automatically shifts to bonds as he ages, gets destroyed. Bonds lose value when rates rise. That's mathematics. Monetary transitions don't happen overnight. They take years, sometimes decades. But people don't adjust behavior until too late. You know it's bad, but not bad today. So you change nothing. Then one day it's bad and you can't undo 20 years of mistakes. What's coming is worse than a recession because recessions are cyclical resets within stable systems. Demand drops, companies lay off workers, the Fed cuts rates, the economy recovers. But monetary transition is a structural reset of the system itself. The rules change, the measuring stick changes, and if you built your financial plan assuming old rules, you're in trouble. I'm diversifying out of purely dollar denominated assets. I'm holding gold, real assets, and a small Bitcoin position. Not because I think Bitcoin is the future, but because if there's even a 10% chance it becomes part of the global reserve system, the upside is massive. I'm shortening duration on fixed income. Long-term bonds are terrible bets right now. And I'm investing in skills and businesses not denominated in any currency. The value of what you build doesn't change because the monetary system does. The lease is ending. The tenants are moving out. And if you're still sitting in the apartment, assuming everything will be fine, you'll be the last one holding the bag. Subscribe for more economic reality checks.